Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're discussing a recent report from the Auditor-General that has raised some eyebrows regarding the Ontario Home Construction Regulatory Authority, or HCRA. The report questions the regulator's enforcement practices, suggesting that some builders with questionable professional conduct and financial stability might have slipped through the cracks.
That's right, Sandy. The report highlighted that out of over 3,000 new applications in the last 5 years, only 2 were rejected. This seems to point towards a very lenient approach in granting licenses.
It is quite concerning, Steve. The report mentions that the HCRA has a fast-track renewal process that seems to rely heavily on self-reporting by the builders. This means builders declare themselves free of any investigations or disciplinary actions, but the HCRA doesn't really verify these claims.
And that fast-track process has grown quite significantly, from 8.4% of renewals in 2021 to 22 to almost 40% in 2024 to 25. That's a huge increase without adequate checks in place.
Exactly, and what's worrying is that there were 134 cases where companies had open complaints against them, with some even considered high risk due to serious allegations like verbal abuse or harassment.
It's a huge red flag, Sandy. If these companies are still building homes, it really raises questions about the quality and safety of the homes being produced.
The example of GC King Bond GP Inc. is particularly troubling. Despite being under investigation for over 550 days, they got a license renewal and then faced penalties for multiple code of ethics violations shortly after.
And that company is still able to sell new homes despite being in receivership. It makes you wonder about the effectiveness of the regulatory body in protecting consumers.
Karen Somerville from Canadians for Properly Built Homes called the report scathing, yet not surprising. Many homeowners are struggling with homes that don't meet building codes, which is heartbreaking.
I can see how this situation is tough for homeowners, but from a business perspective, it also highlights the need for more robust financial risk assessments. The current reliance on a single credit score is clearly insufficient.
And the report mentions that even when builders fail the credit check, most are still approved. This really questions the value of the Assistant Deputy Registrar's review process.
Craig Macklin from Lumberman's Credit Reporting Group pointed out that the credit data used by the HCRA might not be detailed enough, which could be contributing to the problem.
The backlog of open complaints has also grown significantly, from 129 in 2021 to over 1,500 in 2025. That's more than 1,000% increase.
The Ministry of Public and Business Service Delivery and Procurement doesn't seem to be in a hurry to change things either. They pushed back on establishing technical competency standards for builders.
It seems there's a lot of political pressure to build homes quickly, which might be impacting the regulator's ability to do its job effectively.
Indeed, balancing the need for rapid housing development with ensuring quality and safety is a significant challenge, one that needs immediate attention.
Let's talk about the latest insights from RBC Economics on Canadian housing affordability. According to their recent report, while homeownership costs have been easing for about a year and a half, this relief might not last much longer.
That's right, Sandy. RBC Economics attributes a significant part of this improvement to robust household income growth. They noted that more than a third of the decline in their national aggregate affordability measure is due to rising incomes. However, the pace of these gains is expected to slow.
The report highlighted that the affordability measure dropped to 53.6% in the second quarter of 2025, a notable decrease from the record 63.5% at the end of 2023. This reflects the combined impact of lower interest rates, softer prices, and stable wages.
However, RBC warns that the pace of relief is likely to decelerate. Earlier interest rate cuts have mostly worked through the system, and we're starting to see a slowdown in income growth, especially as labor markets weaken in Ontario, where unemployment is above pre-pandemic levels.
It's important to note that although cities like Vancouver, Toronto, and Victoria have seen the steepest improvements, they remain Canada's least affordable markets. On the other hand, affordability in the prairies has returned to historical norms, with Regina being the only market where costs have edged higher.
RBC expects a further improvement in affordability by the end of the year, but it might only offset about half of the pandemic-era deterioration. They emphasize that significant progress will become more challenging once interest rates stabilize, as it will depend mainly on home price movements and household income trends.
And with prices expected to hold steady and wages rising only moderately, the scope for further progress is limited. RBC anticipates broadly stable pricing across Canada over the next 2 years, with some regional variations and moderate wage increases.
In addition to these insights, the report also mentioned that mortgage arrears are inching higher, although they remain near historic lows. As of July 2025, 11,430 Canadian mortgages were in arrears by 3 months or more, representing 0.23% of all residential loans.
That's up from 0.15% in mid-2023, but it's important to highlight that more than 99% of Canadian mortgage holders remain current on their payments. However, the Canadian Bankers Association pointed out that arrears tend to track employment conditions, meaning a softer job market could put more households under pressure.
It's a complex landscape, Sandy. While there's been progress, the economic factors at play suggest that homeowners and prospective buyers should stay informed and prepared for potential shifts in the market.
Fergal McAlinden recently explored the question of who's actually moving in Canada's housing market. The article sheds light on the mixed picture we're seeing right now, with home prices sliding in many cities. Despite this, there has been a slight uptick in some regions. It raises the question of which buyer types are finding opportunities in this market even as others are choosing to wait it out.
That's a great question, Sandy. According to Kalson Jang from Premier Mortgage, while many investors are still sitting on the sidelines, first-time homebuyers and those looking to upsize are seeing a better outlook. They're finding more choices available to them.
It makes sense, Steve. Jang points out that families who started off in condos and are now growing are looking to move into larger homes. With condo prices down, these families see an opportunity to buy houses, even if the condo market itself is not doing so well.
Exactly. And for first-time buyers, the lower prices in the condo market, along with reduced interest rates after the recent cut by the Bank of Canada, are making it more feasible for them to enter the market. Even though there are a lot of unsold dog crate condos, larger condo units are still attractive to these buyers.
It's interesting to note that while buyers are finding opportunities, sellers in Toronto might not be as optimistic. Condo prices are expected to keep slipping, especially with more inventory on the way. Some analysts suggest that borrowing conditions need to improve further to bring more buyers back into the market.
Jason Mercer from the Toronto Regional Real Estate Board mentioned that additional interest rate cuts could align monthly mortgage payments with homebuyers' incomes. This could potentially draw more buyers in, but it's uncertain if these cuts will happen in the central bank's remaining decisions for 2025.
Zhang also advises buyers to take a long-term perspective. He emphasizes that buying a home is not like buying a stock. It's about finding a place that fits your family's needs and building your life there. This long-term approach is critical, especially in a fluctuating market.
Right. And while the market might be challenging for some, those who need to move for work, family, or other reasons are finding it more accommodating than before. It's all about aligning your goals with the current market conditions.
In Toronto's West End, there's an interesting trend developing among condo sellers on the waterfront. There's definitely a herd mentality, says Luke Delinda, a real estate agent with Royal LePage Real Estate Services. Sellers are often prompted to list their condos when they see their neighbor's unit go up for sale, creating a flood of listings that can depress prices.
Exactly, Sandy. This influx of listings can be challenging for sellers as they compete for a limited pool of buyers. Luke DeLinda points out that downsizing baby boomers and young professionals with strong careers are the primary buyers interested in these waterfront condos. They're doing well financially, which keeps them in the market even when conditions are tough.
That's true, Steve. However, the increased inventory means that some properties are taking longer to sell. In areas like Humber Bay Shores, there were 53 sales in September, but 302 units were still on the market by the end of the month. The competition is fierce, and sellers often face pressure to lower their prices to attract buyers.
And when properties sell for lower prices, it can create a misleading perception that the entire market is in decline, especially with the influence of social media. DeLinda mentions that the lowest price per square foot recorded in the area was $550, while the highest was $1,027. This wide range can confuse potential buyers about the true market conditions.
Yes, and Delinda also notes that some sellers are opting for stealth mode by keeping their listings off the multiple listing service and instead relying on agents to quietly spread the word. This approach helps avoid the stigma of having a property linger on the market for too long, which can make buyers wary.
It's a smart strategy, Sandy. However, it also underscores the uncertainty many buyers feel about the economy. Despite a recent rate cut from the Bank of Canada, potential buyers are cautious, hoping for more reductions before making a move. The central bank's decisions will likely play a significant role in shaping the market's direction.
Absolutely, Steve. And with the average price in the Greater Toronto Area at $1,059,377 in September, which is a decrease from last year, it's clear that the market is still adjusting. The Toronto Regional Real Estate Board reported an 8.5% rise in home sales compared to last year, but prices are still down, showing that while sales are recovering, there's still a way to go before prices stabilize.
DeLinda also highlights a shift in buyer priorities, with many now paying closer attention to the security features of condos. It's a new trend where buyers are increasingly concerned about safety, which is becoming a key factor in their purchasing decisions. This could influence the types of properties that see more interest moving forward.
It's definitely a complex market, Steve. Sellers and buyers need to be strategic in their approaches, whether it's through stealth listings or focusing on properties with strong security features. The market dynamics are shifting, and staying informed is crucial for making the best possible decisions.
So, Sandy, let's take a look at what's happening in Brock. The latest data from the Toronto Regional Real Estate Board shows a significant drop in home prices there. The average price in September 2025 was $664,489. That's a drop of 21.7% just from the previous month, and a 26% decrease from September 2024. That's quite a plunge, wouldn't you say?
It certainly is, Steve. It's a pretty dramatic shift, especially considering that sales were up by 137.5% compared to last year. It seems that more properties are coming onto the market, with 93 active listings at the end of September, which is an increase of 3.3% compared to a year ago.
That's right, Sandy. The increase in active listings suggests that supply is outpacing demand, which could be putting downward pressure on prices. It's a classic case of supply and demand dynamics at play. More homes available means buyers have more choices, which can lead to price reductions.
And it's not just about the numbers, Steve. For the people living in Brock, these price changes can have a real impact on their lives. Whether they are looking to sell or buy, these shifts can influence their decisions significantly. It highlights the importance of staying informed and understanding what drives these market changes.
Indeed, Sandy. And while the average price for detached houses is down, it's interesting to note that compared to September 2015, overall prices for all houses and condos in Brock have actually increased by 86%. So, in the long term, the market has still seen considerable growth.
That's a great point, Steve. It shows that while short-term fluctuations can be concerning, the long-term trend has been upward. For homeowners and potential buyers, it's crucial to look at the bigger picture and not just focus on the immediate changes.
Exactly, Sandy. And for investors, these kinds of market conditions can present opportunities. When prices dip, it might be a good time to buy, especially if the long-term growth trend continues. It requires careful analysis and a solid understanding of the market, but there are always opportunities in real estate.
Absolutely, Steve. And with the market being so dynamic, it's important for both buyers and sellers to have a clear strategy. Whether they are looking to take advantage of lower prices or waiting for the market to stabilize, having a plan in place is key. Now, let's turn our attention to a concerning story coming out of Barrie, Ontario. A mortgage brokerage company, Sussman Mortgage Funding Incorporated, is under investigation for allegedly defrauding investors of over $100 million. This case has certainly raised eyebrows in the real estate community, Steve.
That's right, Sandy. Sandy Sussman, the owner of the brokerage, is accused of misappropriating funds from investors and failing to pay them back. The Ontario Superior Court of Justice has appointed business advisory firm B. Riley Farber as the receiver to seize the company's assets and investigate these serious allegations.
The crux of this issue seems to revolve around syndicated mortgages. Sussman reportedly convinced investors to pool their money into these mortgages, which were initially used to build single-family homes in cottage country. The appeal was the high interest returns, ranging from 8 to 12%, especially when the housing market was booming.
However, as Sussman transitioned to larger developments in Bracebridge, Innisfil, and Ramara, the risks increased. These projects required more capital and were subject to more variables like planning permissions and construction deadlines. Unfortunately, as the housing market cooled, Sussman struggled to meet the promised returns.
It's troubling to hear that between 2020 and 2024, Sussman paid himself a hefty salary of $4.2 million. To cover interest payments to existing investors, he brought in new investors, asking them to write checks directly to other investors, a move reminiscent of a Ponzi scheme.
Exactly, Sandy. It's reported that many of these new investors signed no documents and were given little information about their investments. The Financial Services Regulatory Authority of Ontario has since suspended Sussman's license, and comparisons are being drawn to Bernie Madoff's notorious Ponzi scheme.
B. Riley Farber's investigation has uncovered some chaotic bookkeeping practices. They found that Sussman lacked financial records prior to 2017, and he commingled all investments into a single bank account, complicating efforts to track the funds.
With these poor financial practices, the actual amount owed could be more than $101 million. B. Riley Farber, along with law firm Aird and Berlice representing the investors, is working to recover as much money as possible. Although some funds might be reclaimed from the sale of unfinished units in the developments, it's unlikely to cover the full amount.
In Bracebridge, for example, the development is nearly complete except for 8 units, which could bring in between $1 million and $1.2 million. Meanwhile, in Innisfil and Ramara, there's potential to recover some funds from the remaining units, but these efforts might still fall short.
This case is ongoing in the Ontario Superior Court of Justice, and it's a stark reminder of the importance of transparency and due diligence in investments. Investors need to be aware of the risks and ensure they're making informed decisions.
Absolutely, Steve. It's crucial for both investors and brokers to uphold ethical standards and maintain transparent financial practices. As this case unfolds, we'll continue to follow the developments closely. Moving on to a broader economic topic, let's discuss the impact of recent U.S. tariffs on Canada's trade balance. According to the latest report from Statistics Canada, our international trade deficit has grown to $6.3 billion in August, marking the second largest shortfall on record. This is primarily due to the new tariffs imposed by the United States, which have significantly affected key exports like copper ore and lumber.
That's a substantial figure, Sandy. The timing of these tariff announcements has really thrown a wrench into our trade flows. Businesses have been rushing to ship goods before the new levies take effect, leading to erratic monthly trade patterns. Nathan Jansen, the assistant chief economist at RBC, pointed out that this has added a lot of volatility to the trade landscape.
Absolutely, Steve. In August, exports fell by 3% in value and 3.2% in volume, while imports rose by 0.9%, led by higher consumer goods. This suggests that despite the trade disruptions, household demand remains relatively resilient.
It's interesting to note that while exports to the United States, our largest trading partner, fell by 3.4% in August, exports to non-US destinations actually went up by 1.8% from the previous year. However, they did slip 2% from July, illustrating the broader volatility in the market.
And the decrease in exports of motor vehicles and parts by 3.9%, following a significant increase in July, highlights the unpredictable nature of the trade environment right now. The drop in copper and lumber exports by 27 and 25% respectively also underscores the challenges faced by Canadian exporters due to these tariffs.
The ongoing US government shutdown has further complicated things, making some detailed tariff data unavailable. Though thanks to exemptions under the Canada-United States-Mexico Agreement, most Canadian exports to the US remain duty-free. Despite the challenges, net trade volumes over July and August are still contributing positively to the third quarter GDP growth, which is a silver lining.
That's true, Steve. Nathan Jansen mentioned that while net trade is not worsening as dramatically as before, the current scenario still poses significant challenges. The Bank of Canada, which considers exports a key factor for its future rate decisions, might find the 3% drop in export volumes concerning. It could influence their decision to potentially cut rates again to stimulate growth and support exporters.
Exactly, Sandy. With the trade deficit growing, there is a possibility that the economy may need more support. The Bank of Canada will be closely watching other economic indicators, like the upcoming labor market and inflation data, before making their next policy decision. It's a delicate balance they need to maintain to ensure economic stability.
As we wrap up today's episode, it's clear that the landscape of international trade and its impact on our economy is complex and ever-changing. Staying informed on these developments is crucial for anyone involved in the real estate and mortgage sectors.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.